Kenya's power sector presents a paradox. Investor interest is strong, yet project execution has stalled. The issue is not a funding gap, as often perceived. It is a structuring gap. Though a moratorium on new power contracts was lifted, project execution remains paralyzed. So, why is capital not flowing? The answer centers on one critical concept: bankability. Bankability is the measure of a project's acceptability to lenders. Without it, financing is unavailable. Key constraints include non-bankable PPAs, unclear risk allocation, and high currency exposure. A new competitive auction system is not yet operational, which clouds the procurement process. This paralysis is occurring just as market pressures are rapidly mounting, creating an urgent scenario. Rising electricity demand is tightening the country's reserve margins, elevating supply risk. Consequently, Kenya now sources over 10% of its power supply from imports. Investor appetite remains strong, but it is conditional on the implementation of specific reforms. DFIs, private equity, and infrastructure funds all require bankable contracts before committing capital. The solution requires three critical and interconnected reforms to the investment framework. Standardizing the auction system will create the clear, predictable process that is foundational for confidence. Bankable PPAs, with clear termination clauses and sovereign support, are simply non-negotiable. This highlights a fundamental principle. Capital does not flow to opportunity, it flows to structure. The challenge, therefore, is one of execution and expert structuring, not one of capital raising. The central question is whether institutions are prepared to structure and deploy capital in this market. Unlocking investment in Kenya's power sector is not about capital. It is about how that capital is structured, how risk is allocated, and how execution is delivered. In practice, this means designing power purchase agreements that lenders can finance, structuring risk to align governments, DFIs, and private investors, and building transaction frameworks that can reach financial close. This is where Delphos operates, structuring transactions and mobilizing capital to turn investor appetite into bankable, funded projects. Because in emerging markets, capital does not move to opportunity, it moves to structure. This is a Delphos signal. Learn more at delphos.co.